All right, welcome to The Explainer. So today, we're diving into a real head-scratcher from the world of finance. What happens when a company reports good news, beats all the expectations, and then watches its stock just fall off a cliff? Well, that's the Advance Auto Parts paradox.
Okay, so here's the mystery at the heart of it all. On August 14th, Advance Auto Parts, or AAP, came out and said they earned an adjusted 69 cents per share. Now, that easily beat what Wall Street was expecting. Usually that's a recipe for a great day. Investors are happy, you get a nice stock bump, but not this time. Instead, the market totally panicked, and the share price cratered by about 15%.
So you gotta ask, what gives? This is the kind of thing that just doesn't make sense on the surface, and it definitely spooked a lot of investors. So, you know what? Let's put on our detective hats. We're gonna dig into the evidence and piece together what really went down.
Okay, first things first. Let's look at the good news, right? The numbers that made it seem like everything was going great. This is the story Advance Auto Parts was trying to tell everyone. Hey, our turnaround is working.
So, the big headline number was this: 69 cents in adjusted earnings per share. I mean, that's a solid beat, way better than Wall Street was expecting, and that's usually a huge signal that, yeah, management knows what they're doing.
And it wasn't just that. Get this. Sales in their existing stores, they actually grew. Yeah, I know, 0.1%. It sounds tiny, right? But after a really rough patch, any growth at all is a really, really good sign. It meant things were finally starting to stabilize.
So look, when you step back and put all these pieces together, the picture seems crystal clear. You've got revenue up, profits beating the street, sales finally stabilizing, even their margins got a little better. I mean, on paper, this is textbook company turning things around.
And that's pretty much exactly what the CEO Shane O'Kelly was saying on the earnings call. He's painting this picture of strength, of stabilization, of all these strategic projects really starting to pay off. So, if everything was so good, what on earth did the market see that made it freak out so badly?
All right, now let's flip the coin and look at the other side of the story, because this is where we find the real reason for the panic. And in the stock market, it's often not about where you've been, but where you're going.
And you know what? The financial media sniffed this out almost instantly. This headline right here from Barron's, it just nails it. See, the problem wasn't what just happened. It was all about the forecast for what was coming next. The future all of a sudden looked a whole lot less shiny.
And boom, here it is. This is the smoking gun. The company cut their profit forecast, what Wall Street calls guidance, for the entire year. And the message they sent to investors was basically, hey, that really nice quarter we just had? Yeah, don't get used to it.
But why is cutting this one number so devastating? Well, it's because adjusted EPS, that's the magic number. It's the metric investors use to judge the real health of a company's operations. It cuts out all the noise. So when you slash your forecast for that specific number, it's like opening the hood and telling the market, yeah, our engine's starting to sputter.
And here's the kicker. The reason they cut the forecast wasn't because sales were slowing down or anything like that. Nope. It was one word: debt. They had just taken on almost $2 billion in new debt to pay for this big turnaround plan. And, well, you got to pay interest on that debt, and those payments come right out of the profits that would have gone to shareholders.
And it wasn't just the debt. Investors started looking around and saw some other storm clouds gathering. For one, the company was still burning through cash, not making it. Then they warned that tariffs, import taxes, were going to hit them harder in the next few months. And on top of all that, they were pretty worried about their DIY customers and whether they'd stop spending. So it begs the question, why on earth would you take on all this debt and risk right now?
Well, it turns out this wasn't an accident at all. Actually, it was all part of the plan. You see, all this short-term pain is actually a calculated and totally necessary part of a much, much bigger strategy to completely rebuild the company from the ground up.
Advance Auto Parts isn't just tweaking things around the edges. Oh no, they're in the middle of a massive overhaul. And it's all built on these three pillars. First, sell off the businesses that don't really fit. Second, streamline everything. Close stores, consolidate distribution centers. And third, and this is the crucial one, refinance all their debt to pay for the whole transformation. So that debt that spooked everyone, that was literally step 3 of the master plan.
Now, a really cool part of this whole plan involves creating these brand new facilities they're calling market hubs. Basically, think of them like these supercharged mini warehouses. They can stock a massive amount of parts and get them to local stores on the very same day. It's all about getting the right part to the right person way, way faster than anyone else.
And look, this isn't just a bunch of fancy corporate talk. They've got real numbers tied to these projects.
They're expecting their new AI inventory system to boost sales by 0.5%. And these new market hubs, they think those will add a full percentage point to sales. It's a classic investment story, right? Spend a bunch of money today to build a stronger, more profitable company for tomorrow.
So, what's the big takeaway from all this? What's the final verdict? Well, to really get it, we have to zoom out. We have to stop looking at just this one quarter and start looking at where the company is trying to go long term.
This was never going to be a quick fix. We're talking about a multi-year journey here. You've got 2025, that's the year of the heavy lifting, the tough investments. Then the first big payoff comes in mid-2027, when they plan to have 60 of those market hubs up and running. But the real finish line, the big prize, is targeted for the end of fiscal 2027. That's when they expect the whole business to be operating on a completely different level.
And what does that different level actually look like? Well, here are the targets. They're aiming for steady sales growth, a really healthy 7% profit margin, and here's the big one: getting their balance sheets strong enough to earn back their investment-grade credit rating. That is basically Wall Street's stamp of approval saying, yep, this company is financially rock solid.
And there you have it. That's the solution to the paradox. The market was totally fixated on the short-term pain, the lower profits in 2025. But the company, they're playing the long game. They're making those painful investments today because they're focused on a huge payoff way out in 2027. It's a classic conflict between short-term thinking and long-term strategy.
Which brings us to our final thought here. This whole situation is a perfect example of how a single headline can be so misleading. The market saw a scary forecast for the next few months. But if you look deeper, you saw a company in the middle of a really tough but potentially brilliant long-term comeback. So you have to ask yourself, was the market's panic justified? Or is this a massive overreaction where everyone missed the first chapter of what could be an incredible comeback story? It's just a great reminder that sometimes, to really understand what's going on, you've got to look past the next quarter and think about the next couple of years.